Hello everybody, what's going on? So NIO just delivered two massive developments that changes the long-term investment thesis for this stock. And Wall Street is severely underestimating what just happened. We are looking at a pivotal moment in NIO's corporate trajectory. We have brand new insights directly from founder Lee Ben detailing the next phase of NIO's strategy, going global 2.0, the commercial expansion of their in-house Senji chip and a very calculated approach to humanoid robotics and robotaxis. When you combine this strategic clarity with NIO's recent fundamental momentum, the picture for NIO stock looks radically different than the surface level noise suggests. So let's start with the big announcement from Lee Bin regarding the Senzi NX9031 chip. Up till now, mainstream media has treated NIO purely as an EV assembly company. But if you look at their technology roadmap, NIO is rapidly transforming into a vertically integrated semiconductor and software powerhouse. Lee Bin revealed that NIO spent upward of 300 million a year at its peak buying NVIDIA Orin X chip. By designing their flagship 5 nanometer Sensi chip in house, NIO isn't saving roughly 10,000 yuan or over $14,000 per vehicle. They are actively unlocking a massive structural expansion in their vehicle margin. Their vehicle margins already climbed to 18.8% in Q1, driven by higher margin flagship models like the all-new ES8. With the Sensi chip cascading across their model portfolio, including the mass market Onvo lineup, NIO is systematically cutting out third-party tech taxes. But here is where the story gets really interesting for institutional investors. The Sensi chip is no longer just for NIO vehicles. Libin confirmed that Sensi has officially begun external supply as well. They are taking order interest and supplying external clients across industry peers, robotaxis, autonomous logistics, and embodied intelligence platform. NIO is successfully shifting from a pure buyer mindset to a commercial vendor mindset. This transition NIO's heavy R&D spending from a capital drag into a scalable high margin recurring revenue driving over the next decade. Now let's talk about the headline floating around humanoid robotics and robotaxis. Libin offered crucial strategic discipline here that every shareholder should celebrate. He explicitly stated that while building robots is natural extension for automakers, given the overlap in supply chain, AI models and sensor suits, NEO will not blindly jump into commercializing humanoid robots or robotaxis in short term. So, why this is a big win for investors? Because it proves capital allocation discipline instead of burning billions upon unspeculative consumer robot project or premature fleet burn rates. NEO is focusing 100% on its execution power on core EV profitability, market expansion, and monetizing its underlying silicon and software stake to other robotics and AI firms. They are selling pickaxes in the AI gold rush rather than digging money pits. This operational focus is showing up directly in their core delivery metrics. Quarterly deliveries surged over 49% year over year to 107,000 units. The flagship ES8 continues its dominance in premium segment above 400,000 RMB, crossing well over 120,000 cumulative units. On the top of that, the rollout of the flagship ES9 executive SUV and expanding Onvo brand, including pre-sale launching of the L80, gives NIO an end-to-end product ladder covering the luxury executive and mass market family segment. But also, they have the moat that no competitors can copy: battery swapping technology. With over 3,900 swap stations built out, NIO's battery as a service model is shifting from an infrastructure spend to a dominant competitive advantage. It solves long term battery degradation concern for customers, protect resale value, and establish NIO as the infrastructure standard for national battery management. When you look at the valuation, NIO is trading near historical low at a forward price to sales ratio around 0.5x. The market is pricing this company like a struggling legacy EV startup. They are completely ignoring the facts. Delivery volume is setting records. Vehicle margins are expanding towards 20%. In house chips are driving hardware cost down, and external tech monetization is just getting started. The noise around short term commodity pressure or broader EV market volatility creates a rare disconnect between the stock price and underlying business reality. NIO has built an elite product lineup, no doubt. A vertically integrated tech platform with sensor chip and unrivaled charging network. As Going Global 2.0 ramps up and execution continue to prove itself quarter after quarter, the long-term upside potential for NIO stock remain exceptionally strong. So hold tight. With that said, thank you so much for being here. See you next one.